It is. Look, based on my notes that I've been sending really since the beginning of last year, that we've been pretty bearish, the most bearish of my career. And we've been advising clients as we went into the December months and the debate on Santa Claus rally or not Santa Claus rally. And our message to clients is we felt like going into this year, the first half was going to be the last phase of the bear market. And that last phase, in my opinion, is always the most painful. And what generally happens, again, in our opinion, is you start to see the larger cap names really sell off because everything else is sold off and there's nothing left to sell other than those companies that are so widely held. And you saw that really start to materialize in December. Again, it's happening today. And the biggest reason really is the macroeconomic environment. I mean, we are decelerating from a growth perspective. And I think the biggest component are two things. One, all the tightening the Fed has done has not filtered into the economy yet, so we don't know how much damage that's going to do. And number two, which I think is the easiest thing to really recognize, is the cost of capital, whether you're talking about a mortgage for a family or a line of credit for a family or commercial loans. When this debt has to get redone this year, they're going to pay substantially higher. So the cost of capital has gone up significantly on a percentage basis. And that means profits and earnings are going to have to come down. And this market has to get reset to the new normal of higher rates for a longer period of time and slower growth. And we're not there yet.
So, Eddie, then what does that look like when you take a look at the S&P where it is today? We're still above 3,800. How much worse is it going to get before we bottom out?
So obviously predicting where it's going to go is very difficult, but we've told our clients, 3,200 on the S&P is not far-fetched in our opinion. We would start buying before we got to that level. We're sitting on a lot of cash, so we would dollar cost average when we got close, a little bit higher from that. But I think you could see 3,200, and then if it deteriorates from there, then you're looking at 3,000 as a potential floor. So I think there's still double-digit downside, and I think it's going to happen in the first half of this year because we're going to start to get earnings revisions. And I think it's going to surprise the market because the market, in my opinion, was not pricing in a recession. We keep hearing soft landing, soft landing. If this isn't a hard landing, I don't know what is when you look at the carnage and the amount of wealth that's been lost in this country. And lastly, in regards to the recession talk, I think housing this year is going to be extremely problematic, and that's what's going to put us into a deeper recession than what this market is pricing in.
Yeah, more than 2/3 of large institutions, Eddie, that do business with the Federal Reserve think a recession this year. You're in that camp. What do you think could change that equation to you? What could eliminate that from your thinking?
Unfortunately, I think there's been so much damage done that there's nothing that the Fed can do other than cut rates, but they're not going to do that. You don't raise rates as much as they did to just turn around and pivot and cut rates. When you tighten up monetary policy as fast as we have in this country, we've never seen anything like it, in conjunction with an economy that's slowing down, I don't know how you come up with another conclusion other than a recession. So unfortunately, I think so much damage has been done now that there's nothing that the Fed can do to save this market and this economy because it's already heading in the wrong direction. The only thing, again, is much lower rates, but if you do that, then you're going to have inflation spike up again, which is exactly what they're trying to avoid. So they're in a no-win situation right now. They're probably going to tighten again in February, and then they'll maybe stop after that. I think you'll get 2 rate hikes at the most this year, and then the carnage is going to be very evident.
So, Eddie, then what should investors be doing at this point? Is there any opportunity within the market, say within some of these defensive plays that might be able to hold up given the larger drop that you're expecting?
So obviously everyone's situation is different. For us, cash has been king. We're sitting on a very large cash position. And finally, for the first time in years, cash is actually paying investors. You're getting paid to wait. Sometimes the best investment strategy is to do nothing at all and be patient. Because if we're right in our assessment of this economy, even though today may look like a buying opportunity for some, we continue to think that patience is going to win at the end of the day and that we'll have better buying opportunities later in this quarter.